Welcome back. You're watching the penultimate episode of Traders Corner, and joining me for the next two episodes is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we'll start off, as we always do, talking about the S&P 500. And I have to say that if you weren't Ray Dalio, who we'll mention a little bit later, or any other fund manager who'd bet against the market, that is just a beautiful chart, isn't it?
Well, it is. It's been a great market this year. Do keep in mind we started off of a very low base at the beginning of this year because we saw that very violent sell-off in December of 2018. So it meant that the market came off very oversold levels to begin 2019. We are currently trading very close to all-time highs again. So, that's bullish, right? But as we've been going on about the last couple of weeks, particularly last week, I mentioned the fact that the market had broken to a new high. The S&P 500 has pushed out beyond 3,000, that big magical round number. But what I did highlight in last week's show was the fact that the trading action does appear to be moving into an ascending wedge pattern, very much like it did back in March and April of this year. And that eventually broke to the downside and saw a fairly swift move to the southwards. Now, it seems we're doing something similar here now. We've got US earnings season on the go at the moment, and it does seem as if the S&P 500 has sort of stalled a little bit at the round figure of 3,000, and it's broken out the lower end of that rising wedge pattern. Now, the first major zone of support comes in at about 29.50, which is where the breakout occurred back in early July. So we need to see whether that zone holds as support. If not, then the 50-day moving average sitting at about 2,900 would be the next support zone. Look, overall, it is still bullish, but I think just be aware that we have broken to the lower end of that rising wedge pattern, and that does probably signal a little bit more consolidation in the near term. And if we zoom out and look at the weekly chart of the S&P 500, so what that means is that every candlestick pattern that you see on this chart is effectively 1 week's worth of trading activity. You can see here that this big broadening pattern that we've spoken about on previous shows is still very much intact. It is interesting to note that we formed a bearish engulfing candle last week off of the upper end of that broadening pattern. So, I'd said all along, just be careful at the 3,000 area or just a little bit above. Just be aware that this is the top of this large broadening pattern, and if it stalls there, you might find a little bit of consolidation sets in. So far, that does appear as if it is the case. It seems as if we're starting to see that little bit of consolidation. Whether it's just more sideways, choppy action before another leg to the upside, I don't know, or whether it actually has a deeper pullback will remain to be seen. But I think what we do need to be conscious of is that the market is fairly stretched on a bigger picture level, and you can see it is at the top of that broadening structure.
Okay, so maybe not such a beautiful chart after all. If you'd managed to catch the ride, or catch the wave rather, you'd have done well. Yeah. What about our own market, Garth? And it'll also tease up a little analysis we'll do of our market stripping out a couple of key shares. Yeah,
well, so here's our top 40 index, which we always look at. Obviously, the largest 40 shares by market capitalization on the JSE. So the 52,200 level is a significant zone that we've discussed on previous shows. It was the neckline of this head and shoulders pattern that formed throughout June. The break below that neckline opened further weakness, and that head and shoulders structure actually met its target. It's now rallied back, and it's now retesting the underside of that 52,000 resistance zone. So we'll need to see here whether that resistance sticks and whether the market fails and turns lower again, or whether it is able to break out through that 52,000 once again. I will say the market's rather lackluster at the moment. I mean, you can see throughout the month of July, it's been pretty choppy. There hasn't really been much of a trend to speak of. And we're actually basically at the same level as we were 3 weeks ago on this market. So it hasn't been a particularly exciting time during July with this market chopping along sideways like this.
Now, I missed the last couple of shows, and you went short, Mr. Price. Have you closed out that trade? Because it doesn't look as if it was doing what you wanted it to.
Yeah, so I have closed it out, not so much for any other reason other than that this is our second last show, and next week's show we'll be detailing or reminiscing, I suppose. So I needed to wrap up the portfolio, so I decided to actually close this trade out today. What we did was, about 2 weeks ago, we went short on Mr. Price when I saw this head and shoulders structure that was beginning to break to the downside. I went short of 350 CFDs at a price of 198 Rand 30. Was looking for a move down to 180, which was essentially meaning it was going to go and retest those prior lows from earlier in the year. Now, it doesn't seem to have done that. It seems to have perked back up. I must say, overall, I still do look at this chart and think probably the bias is still stacked slightly in favor of the sellers, broadly speaking. But it has moved higher. It's flirted with our stop loss a little bit over the last couple of days, hasn't closed above the stop loss. So we weren't stopped out on the trade, but as I said, I'm looking to basically wrap up the portfolio now. So what I've done today is actually closed out this trade at 201 Rand and 38 cents. It means that we lose after costs 1,278 Rand. And that'll really be the last trade that we do on this show, effectively. So certainly not going out with a bang, unfortunately. And it hasn't been a great year, unfortunately. But we'll talk about that in a moment. But in any case, this is effectively our last trade, and I've closed it out, and we've taken a small hit on the chin there.
Yeah. Okay. Well, let's look at those portfolios for the year and how. Sorry. Before we do that, yes. I realized that you want to talk about the all share versus Naspers because it ties into the general kind of feeling of where have we gone this year.
Yeah.
And in fact, in the last 5 years.
Well, that's it. So the reason I thought it'd be interesting to show this is just to look back. I mean, we don't often look back as far as this on the show because it's a relatively short-term trading show. But I figured this is just quite an interesting thing to look at right now. This is the JSE All Share Index, and it goes back to 2012 here. And what you can see is that really for the best part of the last 5 years, our market has actually gone sideways. But that's at an overall index level. And of course, it hides the detail, which is beneath the surface. So it's all very well to say, well, the market's gone sideways. You know, it's not great. I mean, obviously, the 5-year performance of most funds and of the All Share Index is all pretty poor, really. And people are bemoaning this. I have a lot of people talking to me and saying, gee, their pension funds are doing nothing. They've done nothing for 5 years, and they're getting fed up with this situation. Now, it's just interesting to look at it and then to say, well, how much of this JSE's performance has been related to Naspers? And if you were to strip out Naspers, what would it look like? Because Naspers is a very heavy weighting. I mean, it currently makes up almost a quarter of the weighting of the top 40 index. It is one share that has done very, very well over the last 5 to 10 years and even beyond, further back than that. But what it means is that if our overall market's gone sideways and Naspers has done so well, then what does that say about the rest of the market? What would the rest of the market look like if you were to strip Naspers out? Now,
that's quite a tricky exercise, isn't it?
It is a tricky exercise because in order to strip Naspers out, you would need to actually go back each day and work out the weighting of that stock on each day and take it out of the index and recalculate the index. So it becomes quite a cumbersome exercise. Certainly, I could probably do it, but it would take a lot of time. An easier way to look at it is simply to look at this chart. And this is the All Share Index relative to Naspers. Okay. So what you do is you take your JSE All Share Index chart, take the value each day, and you divide it by the corresponding value of Naspers share price on a daily basis. And what you get is a figure. Now you add or you connect all those relative performance figures to form a chart like this. And that's what it would look like. So take Naspers away from the JSE, and that's basically what the rest of the JSE All Share Index has done over the last nearly 10 years, actually.
I mean, it's not hard to see why most people are in a slough of despondency at the moment.
Well, exactly. And the thing is that that's at an all-share index level, right? If you consider the fact that the JSE really has been a minefield where there have been a couple of proper landmines that have blown your legs off, like Steinhoff, like Brait, like Mediclinic, like EOH. I mean, we can sit here and we list a list of shares as long as my arm. There's been a lot of very, very disappointing share performances on our market. And as I say, the reason I bring this up really is just to illustrate that Naspers really does mask the weakness in the rest of the market. The all-share index looks, well, okay. I mean, it's gone sideways for 5 years. It hasn't done well, but it hasn't been a disaster at an all-share index level. But when you look at it and you scratch below the surface and you look at this chart, which shows you what the all-share index would look like without Naspers in it, it's been a horror show.
Yeah, and it goes a long way to explaining why people are feeling poorer and are worried about their pensions, especially if they're at kind of pensionable age.
Well, correct. And also remember that a lot of funds won't have Naspers in the full weighting because to have a quarter of
dangerous.
Well, it's too reckless to have a quarter of the fund invested in one stock. So you'll find that most funds are inherently underweight Naspers just for that reason, and therefore would have underperformed the market.
Of course, the question for everyone is whether this is the whether the hour is at its darkest now, whether we are going to see some sort of return to life in the South African economy and hopefully ergo in the South African stock market. That's the big question.
Well, it is. I mean, is it darkest before the dawn? It often is. I suppose that's assuming you believe the sun will come up and there will be a dawn. Which is debatable. I think on some levels, look, there's value in the JSE. There's no question about that. In the domestic sectors of our market, there is value. The question is, will we get the economic growth that we need to unlock that value, or is this going to remain a value trap?
Yeah. All right, Garth. So on that somewhat sobering note, let's see how the portfolios have performed. Because you have inched into the green, but nowhere close, I suppose, to what you would have liked to achieve.
Yeah, that's it. So, I mean, we've inched into the green, you're right. There's our local portfolio up 3.3% for the year to date, certainly not shooting any lights out there. And then our offshore portfolio is also up about 3.5% for the year to date. So look, I mean, I'm happy we've made money. We've done better than Ray Dalio in the first half of the year, as you mentioned. His flagship hedge fund, $150 billion hedge fund, is down nearly 5% for the half year. So I suppose we've done better than that. But you can't also take one half-year performance of a guy like Ray Dalio and extrapolate that. I mean, he's an amazing fund manager. And I guess I shouldn't be trying to look at the lowest common denominator either in terms of justifying our performance for this year.
Well, I mean,
but
last year I think his fund did 14% return, I think,
look,
after fees.
Over the long term, he's done phenomenally well. And that's why you can't take one half-year performance for the guy and extrapolate that. He's been a phenomenal fund manager. The point is, you have tough times sometimes, no matter how good you are. We've had a tough time this year. It hasn't been a great performance. And unfortunately, we're not going out with a bang. This show's been going for 10 years. We've had some stellar performances during those 10 years. Unfortunately, this year has not been one of those. I mean,
just, a last comment maybe on how you kind of keep your spirits up when you've had a 6 month or 7 month period like the one you've had, or I wonder how Ray's feeling after his 6 month performance. There's a little bit more focus on him, admittedly, than on us.
Of course. No, look, it's frustrating, but we're not losing money. And I'm also confident that the processes that we follow, the rules that we follow do work. It's been shown to work over the last decade that we've been doing this show. So I would stick at my knitting and keep going. And, all it takes is a 3 or 4 string of winners consecutively, and it changes this picture dramatically. And we have seen that in the past. As long as you manage the losers and you keep your risk in check, you can do quite well ultimately by just managing the losers and letting the winners take care of themselves.
Yeah. Got some admin, you've got a couple of course dates coming up, and also how viewers can keep a handle on what you're doing in the future?
Right, so we've got my final high probability trading course in South Africa will be on the 3rd of August. It's in Johannesburg. It's a Saturday. Anyone that would like to attend this, or who's always wanted to attend but never did for whatever reason, now's your opportunity. So email me, garth@traderscorner.co.za, and I'll send you all the information. And then lastly, as you mentioned, we've got our free week emailing list. And if you go to traderscorner.co.za and you go to the middle of the page, you'll see there's a link to click on a free weekly email. I will continue to use that mailing list to communicate with followers. We will be taking this show digital going forward once I get to the UK, and I will reinvent it. I'm going to look at far more offshore ideas and try and spruce it up. I think it's in need of a bit of sprucing up, and I'm excited about what the future looks like for Traders Corner.
Yeah, so am I, although I shall miss your physical presence in the studio. But of course, we have 1 week ahead of us, and we're going to look back at a decade, I hope. It'll be very instructive because we've collected a lot of data over the years. But Garth, we'll leave it there, and we'll be back with Traders Corner next week.